Okay, guys, welcome to TFC Daily, initiated by the team at the Financial Coconut to keep you company during these tough times. I'm not sure how long we'll be staying at home. So follow us on our socials, check out all our podcasts for your continued enjoyment, okay? A learning enjoyment. Simply head to thefinancialcoconut.com for more details. We have different segments for you. And yes, welcome back to our Monday, Tuesday segments of TFC Stock Geek Out. And Thomas is with me, and we have Chris in the house. So yeah, all the good juices. We're going to talk about all these interesting companies. But before that, we have a word from our sponsor.
Moo offers commission-free trading of stocks, options, and ETFs anytime, anywhere. Enjoy real-time quotes, free level 2 data for better investing decisions, and latest news in social community. Moo, your one-stop trading platform. Enjoy our promotions now.
Yeah, if you want to get your one free Apple share, you got to be fast at 31st May. Last few days coming, right? And today we're in the house. We have Chris from rethinkwealth.com. Yeah, hi, Chris. Woo!
Hi, Reggie, Thomas. Great to be here.
Yeah, by the way, Chris just came back from Indonesia. And yeah, he's like currently in lockdown. Last 2 more days before he's out, right? So thank you for joining us, and really happy to have you with us. And you also do a lot of content for us with our backend, right? So all the good stuff we're building, a lot of interesting good juices, and you're going to launch your fund. So later we can talk a little bit about interesting progress in your life. But before we begin, maybe you want to just kind of share with us your read on the market. What is going on? What are you looking at? What is happening for you?
Yeah, sure. I think the market, we are in a very interesting situation this year. Last year, March 2020, we saw one of the fastest bear market that we have seen in the history of stock markets, right? And we have seen, I think, might be the fastest rebound as well of the bear market.
Yeah, what shape? V shape, U shape, K shape?
Yeah. So I think people were wondering if there's going to be like a V-shaped recovery, W-shaped recovery. There's all talks on that last year. But basically, one thing that was certain is that it's not going to be like a disease that will like sort of like wipe out humanity or things like that. And as with many kinds of crises that us humans have gone through before, the innovation of the biotech sector with the coming out of the vaccines, I think in record time, in less than a year, I think there was a game changer. And after the vaccine was proved to be quite effective, then there was this like a sort of like optimism, right? And the market quickly rebounded. But after that, then the market sort of realized, hey, the vaccine needs to be produced and it needs to be delivered. Then the market started to go down a little bit again. But throughout those times, there were throughout last year, one particular group of like companies actually prospered, and those are the tech companies. Those are the growth stocks. And right now, what we are facing in the last few months is the potential of these like so-called growth stocks. Is that are we paying too much premium on that because
Not
of
a
like
mouth-watering
inflation?
deal, right? Not a mouth-watering deal.
Yeah, I mean, like markets always markets usually are always on. Well, sometimes like market are quite rational, but quite often times market are either too optimistic or too pessimistic. And I think what we are seeing right now is that people are thinking if we are paying too much of a premium for this kind of growth companies, and that's why you see the growth companies that actually suffered are the growth companies that hasn't been performing as well in terms of the business. And the growth companies that still doing pretty okay are the growth companies that are still performing well in terms of the business. So I think the theme that we are going to see this year is that, oh, by the way, this is all for educational and informational purposes only.
Not a recommendation. Yes.
Yes.
Must put caveat, yes.
Yes.
Yeah.
I think we are seeing some theme this year is probably one of the theme that makes more sense are the reopening theme, the reopening trade, because although the vaccines are taking quite long, but I think if I'm not wrong, as of today, I read that the world has administered about 1.7 billion doses of vaccine, although it's still very, very low percentage of the amount that we need for the world of about 60 to 70% to reach that kind of level of immunity. But I think we are getting there. And I think potentially, right, as you see last year, the companies that prospered was the companies who are the growth companies, who are the stay-at-home companies like Peloton, companies like that. And and maybe
Peloton just been whacked. Boom, 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 boom.
yeah, I
Yeah, it
think
is.
how much have Peloton went down now? Let me check.
I don't know, but yeah, their business, they're recalling all their products, right? Because they got some issues with their products. So yep, it's a shit show at Peloton at this
Yeah.
moment in time.
Yeah. But I think they've gotten quite a lot of new customers from the lockdown last year as well. So I think like potentially in the reopening trade, we might see some of these like travel companies or like leisure companies, maybe like cruises. We're going to talk a little bit about that later. I think there are some pent-up demand. I'm sure like Reggie and Thomas.
I can't wait to go out. Yes, I can't wait to travel. I can't wait to just like do my thing. So yeah, I get that.
Exactly. Yeah. So I think there might be some potential in this kind of like rotations, but of course, ultimately it must make sense. So I think as we receive more news, more business and fundamental related news with regards to these companies, and it is a fact that, there's a real pent-up demand, and it's a fact that people are booking, and it's a fact that people are starting to fly, then I think investors will start to realize that these companies might do well in the next maybe 1, 2, 3 years.
So what is your investment ideology then? How do you decide what kind of companies to go for? What do you look at? What is your core ideas?
Well, I mean, I don't like to view myself as a particular group of investors, so I wouldn't call myself value investor, or I wouldn't call myself growth investor. I just call myself maybe like something along the line of a business-focused stock investor. So I see value in many kinds of opportunities. I see value in growth companies. I see value in turnaround companies. But ultimately, I have this framework. I call it just the 4M1S framework. You can just Google it, 4M1S framework. So the first M is the mindset. So what's important here is that us as investors, as stock investors, we often fall into the trap of looking at the stock prices and be affected emotionally by the stock prices. But if you notice, if you own a business, you don't go every day and ask, how much can I sell my business for? So the first mindset, the first M is that we should view stocks as having a stake, having an ownership in a real business. So that business focus, business owner mindset is important. The second M is management and business, right? Ultimately, the two like key quality that we need to look at for any kind of companies are, hey, who are running it? What's the track record? Are they good at the execution? Are they good at their integrity? Things like that.
You know why I laugh? Because we're going to talk about Bill Ackman later.
Yes.
Because of Pershing Square. So there's a lot to talk about his track record. But yes, continue, please. Yes.
Yeah. So management and business. So we need to make sure it's a quality management, and is it quality business, or what kind of business is it? So you must understand the business well in relation to the management, right? And make sure that these two things are within what we call our circle of expertise or circle of competence, however you want to name it. So the third M, I call it like mathematical sense. Does it make sense like mathematically? What's the valuation? How should you value it? Different kind of business, you should value it differently. So you must make sure that you are valuing it correctly. And you must make sure that you put a margin of safety, and you must make sure that you have taken care of the downside risk. Then the fourth M is money and portfolio management. It's not just about what stock you invest in, it's about what percentage of your portfolio you invest in that stock. So I am of the view that I like to invest in things that I have high certainty about. And if I do have high certainty about, I don't like too much of a a diversification, because if you diversify too much, then you are generally just getting the market return. The source of alpha and outperformance is really quite hard to get if you diversify too much. That's my view. And the last S is strategy. I think different kind of business, different kind of target price, different kind of valuation, and really like different kind of environment, you should have a different kind of strategy to profit from it. So I use quite a variety of strategy. I can simply buy the stock. I can sometimes buy at once, or I buy in batches, or I can buy call options. Call options is for most people is much more dangerous than stocks, because you may lose all your money easier. But even the great investors like Markleberry uses call options. The billionaire value investor Joel Grimdat uses call options as well, and I use call options too. I like call options, and of course, sometimes there's opportunities for selling put as well.
Fair, that's cool. Yeah, thanks for sharing with us your ideas and your core ideas, right? So before we go into the companies today, which is very much a reflection of your ideology, you're not centered in tech, or you're not like, I don't see like a very big growth story or a big value story. It's like we have Microsoft, and then we have Pershing, and then we have like Carnival Cruise, like so they are all over the place, and we'll have a good discussion. But we have one question from our listeners from Mumu. So what are your thoughts about the market? When will it start to pick up, right? So we're not trying to time the market, but just want to hear a little bit of your thoughts before we go into Microsoft.
Sure. Depends which market, I guess. As Reggie has mentioned, I think we don't know when the market will pick up, because I don't do any technical analysis. It's all like purely about understanding the business. If the business do well, we think that the stock will likely do well. I mean, like if you think about the market, right? Even in the time of like the Japan stock market that has been going down for decades, I think back then, even in those kind of market where the market has been going down, I think there are many companies who have went up a lot, like 5 times, 10 times. So what does this mean? I think this means that in every market there's opportunity. It's all about how to identify and what company you want to invest in the market. Because I don't really invest in like indexes in general, so I don't really have a view on the market. It's all about the view of the business, because that's where your outperformance will usually be coming from.
Nice. So why is Microsoft an idea?
I
I
mean,
mean, it's already so big, right? They're already doing
yeah.
so many things. They've been out there for so long. Why at this time, you want to talk about Microsoft?
Yeah. So disclosure, I have Microsoft in my portfolio, but I don't have the stock. I have the call options, and I view the call options as more attractive in my view than the stock. But in general, I think the stock is the company is offer good quality kind of companies where the competitive advantage is really strong and pretty durable, and they have been able to evolve pretty decently if you think about it. I mean, they started as like Microsoft, right? Your Microsoft Word, your Microsoft Excel, and then they started to offer instead of buying the license, you pay a subscription. So they make sure they lock you for the year, right? Then, they know that their customers are all these like working people. So they have Microsoft Team, which they launched in the pandemic year, right? And the traction for Microsoft Team has been doing very well too, from the last time that I read about it. But not only that, they have ventured into the cloud business, right? Because the Microsoft Azure, their cloud business is really quite strong, and it's now, if I'm not wrong, it's an approximately $20 billion business for Microsoft. And last year, I think in fiscal 2019, it grew at about 56% for Microsoft. So that's why they say that sometimes the next Amazon is Amazon, and the next Microsoft is Microsoft. And if you notice, right, the FANGs, the big companies, actually grew very, very well, even though they're already so big. So I mean that it's not about whether the company is big, although if the company is big, it does offer like certain kind of indication to how much it can grow. Of course, smaller company it can like grow easier to maybe 5x, 10x. But I think even big companies, if they have a bright future, if you think that they have a bright future, then there could be some opportunities to maybe make like, I don't know, potentially 30%, 50%. Yeah,
Can you, so I
from the
think
stock.
I think a lot of people, when they look at Microsoft, or if they even look at Microsoft, in their head it's really very basic software, right? Like where Microsoft is, and at its core, it's OS. But actually, I think a lot of people don't know that in the cloud business, Microsoft actually uses a lot of licenses, right? So in the cloud business, there's the whole open source development where you can develop everything everywhere on any kind of cloud provider. But Microsoft has its own enterprise ecosystem with Azure and all, right? And if you want to develop on that back end, you actually have to pay licenses to use, their OS and their ecosystem. So they essentially they make a lot of money just selling you entry into their platform, right? So and I think their business is a lot more sophisticated than what a lot of people understand it. So I hope that you can kind of help us understand what are some main components of Microsoft, as a business.
I think Microsoft has generally a few kinds of like segments. They have their Microsoft Office 365, where I think it's one of their bigger segments, where they get their subscriptions from like Microsoft Teams and like from like Microsoft Word, PowerPoint, etc. And they keep on updating this software as well. So that's why like when they do this through the cloud, a kind of system is actually more efficient. And Microsoft also has quite a good segment in terms of its acquisition on LinkedIn. And the segment that is growing quite fast in the most recent year is actually their gaming segment, their Xbox. And they're also coming out with the, I think, Xbox Game Pass or something, where they plan to deliver the gaming experience through cloud. So if you look at Netflix, right, Netflix have sort of transformed the industry of, watching movies. Last time we go and rent like DVDs, right?
And
And
I was never in that period. I never rented DVD before. I knew that there was an era, but no, it's not. I didn't do that. Okay.
I think last time when you tell like people, hey, next time you don't need to buy DVDs, it's all online. People will find it hard to believe because the DVD, there are so many gigabytes, right? And Netflix has done it. So right now the question is that for games, can we do it or not? Because games need even larger like amount of bandwidth and like larger amount of like memories. But I think the key is that Microsoft is trying to innovate and they are trying new things. And as long as they continue to do that, then they are lowering the risk of them being disrupted by trying to always disrupt the industry.
So I don't think that's just all about Microsoft, right? They also had some acquisitions of, say, GitHub and LinkedIn and all that. So maybe you can share more about that side of things as well.
Yeah, I mean, I'm not. In terms of their acquisitions, they have traditionally been able to actually acquire like pretty well. In terms of really not just acquiring, but also like growing the business that they acquire. So for LinkedIn, we can see that there have actually been some executional improvement over the last few years. I don't know. I'm sure you guys have LinkedIn as well. And you will notice that a long time ago, there's no such thing as sales navigator, blah, 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 right? Inside of LinkedIn. And now they have that. And I think people do sign up for it, even though it's so expensive. So I think they have taken advantage of the SaaS model quite well through their acquisition. So I think they have been quite a good acquirer, but of course they do have that kind of liberty as well because their other businesses are generating huge amount of free cash flow and they have like pretty decent amount of cash. I think they have like enough cash to cover all of his long-term debt, if I'm not wrong. So yeah, I think no issue
Definitely.
with that.
Definitely. And I mean, I have some friends in the tech space. They code and they do all those kind of stuff, right? And they say that actually Microsoft has very low engineering debt. I'm not sure if you guys understand what's an engineering debt. Engineering debt is when you're building a software and then you're just kind of patchworking along the way. You just keep patchwork, keep like adding things. And a lot of big tech companies actually have very big engineering debt, right? Amazon and some many other only guys in the engineering space that are building these kind of softwares and building products understand this, right? So from what I understand, I don't code, but from what I understand, some of my friends were telling me actually Microsoft is super lean on engineering debt. They think about their product in a very holistic fashion, right? So which is why they have very high hit rate, even with LinkedIn coming in, with GitHub, with all these kind of interesting stuff that they acquire, they can continue to push forward. But sometimes I think they're a little bit slow to things. I'm not sure if that's a fair statement. Like Office, so long, man. Office.com finally they're going cloud, right? After so long. So do you have any thoughts about some headwinds or tailwinds for Microsoft specifically?
I mean, in terms of headwinds, probably they have like gotten a huge growth in terms of new subscribers or like new members for their digital like ecosystem products, for their Microsoft Teams and for their Office. And I think that kind of growth rate could I don't think they'll be able to sustain that kind of growth rate after the pandemic. But in the long run, I think digitalization is here to stay, and there's that tailwind as well. So if you look at 5-year to 10-year time horizon, I think more things are going digital. And you'll be surprised, right? Because like we think that, oh, so many things go digital already. But I think there will be more things that will be going digital, like for example, like the Internet of Things. And like next time, there'll be more things that will be connected to maybe you, your watch, your glasses. Microsoft is also quite big on the augmented reality kind of like products with their HoloLens, if I'm not wrong. And I think there's gonna be something interesting that they'll be doing in the long run. Yeah. So I think that's a good tailwind for them.
Yeah, Chris,
Nice.
we got a question from Charles via Mumu. So he's asking if there's any advice for new investors, like which stocks should he actually invest at the beginning. So I think it is quite timely because we got 3 stocks that we're looking at, right? Microsoft, Pershing Squares, and Carnival, and they're 3 really different kinds of companies. And for new investor, right, what are the kinds of companies that they should be looking at? Like if they're just starting out, what's your advice?
Well, I think for new investors, I don't think the question should be which stock you should invest at the beginning. For new investors, the question is that which company you think you would understand if you read up more about the company. So I think that's the first one. Which company do you understand? To answer that question, sometimes actually it might be already in our day-to-day life. So for example, like most of you might be an iPhone user, right? So then you look at Apple. Then you can just Google Apple investor relations and you can try to read up more about the company because they have like a investor presentation, like quarterly earnings. If you understand the company, then it wouldn't be so hard to read up more about the company. So I think I would start there because you'll be quite surprised if you just look around you. There's actually quite a lot of things that are already around you that are already listed in the stock market. For example, if you go to Starbucks, Starbucks is listed. Then if you buy coffee from Starbucks, but you don't want the normal milk, right? Then you want the oat milk. Oatly. Hey, Oatly is already listed. But of course, you have to read up more about the company and try to understand it first before you invest in anything. Then if you use hand sanitizer, Dettol, right? Dettol is listed. If I'm not wrong, it's by Reckitt. So there's a lot of like company around you that is already listed. All you need to do is trying to do your best to understand them. Because if you ask which stock you invest at the beginning, I would say that it's dangerous, and also it's not productive, because what you want is that you want to do the actions that will allow you to be an investor for a long time. And the actions that will allow you to be an investor for a long time is not to ask and to know what stock to invest in, is to try to think of the process on how will you know what stock to invest in. So I think we could work on the first two things, like try to understand the company that you invest in, learn more about them. If it's too tough for you, if it's too complicated, just skip it.
Avoid
just skip it.
pharma, avoid oil and gas, avoid mining, all those things that are very, very far from your life in the early days. I think that's my take. In the early days, try to go for exactly what Chris said, right? Try to go for things that you understand. You know, your donut shop, your coffee shop, your supermarkets, the things that you understand, your Nike, Adidas, whatever. I'm not naming anything specifically, but it's just like try to work on companies that you have a general affinity for and you understand them. Just read through the FS, read through the annual reports. Okay, I know a lot of people will teach you how to do like annual report hacks, Control F. Okay, like all the Control F hacks, this keyword, that keyword. My take is, in the early days, you want to really double down on one sector and read 3 companies in that sector specifically and read the whole thing. Right, so let's say you're very big on fashion and you want to buy Nike, so just read Under Armour, Nike, Adidas, or Lululemon, whatever. Right, read the whole FS. It's going to be 100 over pages each. Yeah, it's quite wild. It's quite wild. But once you read through 3 or 4 of them, you will get a general idea what is in the space, because they will tell you that, oh, we do a licensing from so and so this company, and then we have some sort of agreement with Timberland to do something. We have a distributor with JD, blah blah blah. Right, so everything is listed in the FS, and if you read through the whole thing, you really get a very good idea of like what is going on in the space. But a lot of people want quick hacks, and you will always be relying on stock tip and analyst report and all those kind of shit if you go down that path. Right, so I think for everyone that's trying to learn and trying to really be a good investor and kind of do for that 10, 20, 15% growth that you are looking for as an investor to pick companies to get alpha, right? Then do the work lah, right? Don't so lazy.
Or subscribe to Financial Coconut and Retain Wealth.
Thank you. Random slot, yes. So I think that kind of sums up Microsoft, because Microsoft is a big giant. I think we can go on and on. There's a lot of things about it, but it's the same general idea with every other big FANG company or big tech company. They have a very big segment of their business that is generating a lot of free cash flow, and then they go about growing other side of the business. And generally, because they are in tech, they all have this they all have this tailwind of digitalization into the future. And we can go on and on talking about Microsoft, but we're gonna take a break at this moment. Our sponsor have something to tell you. After that, we'll come back to talk about the exciting thing, Pershing Capital. Yeah, so stay tuned, guys. Drink some water.
Moo offers commission-free trading of stocks, options, and ETFs anytime, anywhere. Enjoy real-time quotes, free level 2 data for better investing decisions, and latest news in social community. Moo, your one-stop trading platform. Enjoy our promotions now.
Okay, we back. Had some water, take a break. Yeah, now we're gonna talk about the interesting company, or the quote unquote the hot thing, right? SPACs. Everyone wants to talk about SPACs, and they want to hear, what is a SPAC? What is the most interesting new phenomenon? Or maybe actually it's not that new, right? So I want to hear your take. Elaborate for us, like what is a SPAC and why Pershing, and all these kind of stuff.
Sure. So a disclosure, I have Pershing Square Tontine Holdings stock. If you think, so Reggie, you're right. SPAC is not a new thing. In fact, many years ago, Bill Ackman worked on a SPAC before, and he actually owned the company for quite a long time. And that company actually made him, if I'm not wrong, around 20% a compounded annual growth rate for many years. So that SPAC, that company that he has worked on for many years before that, I think it was called Restaurant Brands. So a Restaurant Brands is a company, if I'm wrong, in in America that owns like Burger King, all the kinds of like food companies. So Bill Ackman is not new in the game of SPAC, but this SPAC thing has been like booming since the last 1 to 2 years. And the logic is that it's an easier path for companies to go public because it takes shorter time, there's lesser requirement, it might also like cost them less. But depending on the terms of the SPAC, there might be huge dilution involved because the guy that actually raised the fund for the SPAC, these sponsoring companies traditionally get like a huge percentage of the SPAC, maybe like 10 to 20% in return for like cents on the penny, right? So yeah, so for Pershing Square Tontine Holdings is currently the world's largest SPAC. It's about 5 to 7 billion blank check company from its website, as I can see. So it's a company that is quite unique in terms of the structure because for the PSTH, for the Pershing Square Tontine Holdings, in terms of the kind of dilution, the terms that they actually give for their target company, from what I read, is not as dilutive as other kind of SPACs. So it's more investor friendly. And of course, another differentiation is the fact that it's the world's largest SPAC. So by doing that, they can like probably get a bigger kind of like target for the SPACs. So some of the one of the reason why I was quite interested in PSTH, in Pershing Square Tontine, is that their acquisition criteria that is displayed in their website, pstontine.com/acquisition-criteria, is that these are the criteria that I think is quite a good checklist for generally for like our kind of investment as well in general. So let me just share it with you guys. So the first criteria is that Bill is looking for simple, predictable, and free cash flow generative business. You see the wording: simple, predictable, and free cash flow generative business. This is like a Warren Buffett style, right? And you notice like Warren Buffett like to invest in predictable business, in a business that he can predict the future, so that he can like ascertain the value of the company, and he plans to buy below the value, which is what like PSTH is trying to accomplish. And he's looking for companies with formidable barriers to entry. So he wants to look for companies with long-term sustainable competitive advantage, wide moats around their business, and he wants the company to have limited exposure to extrinsic factors that they cannot control. So that means that he really wants a company with a wide competitive advantage, with simple, predictable, and free cash flow generative, with a strong balance sheet, minimal capital markets dependency. That probably like means that they don't want like companies that need the public market to operate their business through like issuing shares just to raise cash and things like that, which you see a lot, right? With like a lot of like growth companies nowadays. He want like companies with large capitalization. So he's not like looking for some like small companies. He's looking for companies that are already big. Attractive valuation.
These guys sounds like a very small subset, because they have to be in the private space, right? Private companies merge with them, and then they can go forward. But he wants big companies, big moats, strong fundamentals, private companies that are willing to merge with him.
Yeah.
Right. So how does that work then? When I evaluate a SPAC, what are some core ideas that I need to have, to look at this? Because these are pointers that he's looking for and all that kind of stuff, which is his core ideologies. But as an investor, what do I look out for, and why do these things matter?
Because when you invest in a SPAC, you are basically investing in the ability of the sponsor to find a an attractive merger target at an attractive valuation. And I like it that one of his acquisition criteria is attractive valuation. So he said that he will seek companies with an attractive valuation relative to their long-term intrinsic value. So when you look at the SPAC, of course, you know that roughly the floor value is probably their IPO price, which is like around their cash price, right? So I think Pershing started with maybe like $20, is it? Then now is at a premium. Why is it at a premium? Because based on the latest like Wall Street Journal Future Festival, I think Bill Ackman said that he is already talking to a target since November. So he is already talking to a target for 6 months. And he really wants this target. And he thinks that it fits his criteria. And like he says, like something along the line of, we will announce something in a matter of weeks. If not, then we will move on to the next one. So
that is like 很像没有讲 like that, you know?
Yeah.
It's like, oh yeah, we're gonna announce very soon. If not, we're gonna move on.
Yeah. So I think if he doesn't announce anything, or if he announce, then the market see, this company not good, then I think the 25% premium will be gone, because you see that often. I mean, you look at AGC, right? So AGC is a SPAC that is going to merge with Grab. It went up like quite a bit. Now it has really gone down. And if you look at the market, SPAC craze is starting to die down. There are many SPAC that have like even went down below their like a so-called like cash value. So I mean, like, we have to be careful. And basically, when we want to invest in SPAC, we have to know what's the floor value and understand that there's a lot of uncertainties. We are basically like investing in the ability of the sponsor to get a good target at a good price.
What's the way that you look at a SPAC actually? Because it seems very different from investing in, say, a company that lists, right? But rather a SPAC seems like an investment vehicle instead. Yeah. So the criteria that you look at it will really be something different also. And what are the key things that you're actually looking at on maybe on a weekly basis or a monthly basis as compared to a company?
Because now they have a premium, right? Essentially at 25%, on cash, right? So I think all these things are very good discussions and gives people a general better ideas. Like, okay, even though I may agree with this manager or this spec, this ideology, right? But when do I buy it? Or how does that work?
Yeah. Of course, like if you believe in the managers and you believe that he's going to like acquire and at a good like valuation, the best price to buy it is at $20 when there's no premium at all, when there's 0% premium. Because the higher the premium is, the higher the risk. Because those like premium are like what? Are like just expectations, right? It's basically just optimism. So the higher the premium, I would say the higher the risk. The lower the premium or no premium at all, or if the SPAC is trading below the cash value, that's the best price to buy if you believe in the sponsor and if you believe that he's going to have a good target. So investing is both an art and science. Depending on the company, you look at a combination of quantitative factors and qualitative factors, right? So SPAC is, in my view, is like more or less, if they haven't like announced any company, then it's more or less like a qualitative like factor. Basically, it's simply, the question is that, do you believe in the sponsor's ability to acquire a target at a good price? As simple as that.
Yeah. So Tim asked, wasn't he, so Bill Ackman, right? Wasn't he talking about Stripe since November, but they raised capital lately, didn't they?
It's like, don't need your money anymore.
Okay. I have to say that when I invest in SPAC, right, I have no clue. I have no expectations on which company they will merge with. When I invest in SPAC, I don't invest because I think they will like merge with Stripe, or because I think like I invest in SPAC if I think that the premium is not so high, and I think that the sponsor is of a good like ability to really find and source like target at an attractive valuation. So something like Bill Ackman have had like good track record, based on the based on the restaurant brands and like based on his like track record. This past 2 years has been quite good actually. His investment track record.
Yeah. But are
So-
you concerned about a space where there are more and more specs? Essentially, there's more and more like capital being blank check capital sitting around and looking and hunting for companies. So it's the whole same problem with M&As, right? When there are a lot of companies, they have a lot of cash sitting around and they're trying to do M&As, they get bidded up, right? So they may be paying a premium for all these companies. And are you concerned that this whole spec growth is gonna make a lot of these acquisitions that they buy thereafter not as juicy because there's a premium packed to competition and just a lot of capital going around chasing after limited deals?
Definitely. Then all the more that we must ensure that when we invest in any SPAC, we must have a high conviction of the sponsor. And like I think the market have quite a good impression on Bill Ackman. That's why he's trading at a premium, right? Right now, at a like 20% ish kind of like premium. When you look at like other specs, they don't have that. Even the spec that is already like announced going to merge with Grab, I think it's only like trading at a 10% plus premium. Started at 10. I think it went to as high as like 13, 14 maybe. Now it's back to like 11. Yeah, but again, like probably like because Grab valuation is at about 24 times price to sales. So SPAC that like there's a combination, because if you are too optimistic when others are optimistic, for example, you go in at a 30% premium, all right? Then if let's say the merger target is not good, or maybe the merger target, the valuation that they're going to merge at is too high, then it may like come back down and you may lose your money as well.
Yeah. So you're very positive about Bill Ackman, a restaurant group and all that, but Bill Ackman has the whole other side of the story with Valiant Pharmaceutical, with Herbalife. I mean, they do a lot of those. So I have to poke, right? Because Bill Ackman is he has big successes, but he also has big failures. So Valiant Pharmaceutical, not long ago, a few years ago, was one of his worst, investments out there. And it is, if you look at it, it is quite like a SPAC, in the sense of like just a lot of pharmaceutical companies put into one. They don't have operational synergy and they don't really have, they kind of operate independently. So it's very much a little bit like a SPAC, right? So, or at least the ending of how a SPAC will look like, which is a holding company of all these different companies. So are you concerned about his history with Valiant?
So I think like people make mistakes, and what's important is that we have to learn from mistakes. And I think I was listening to a podcast. He was like saying like some like stories about his mistakes with like Valiant, Herbalife, his fight with Carl Icahn, the one that he lost. I think he sounds like a guy who have learned and grew from his past mistakes. And I think he was like also saying that he got married, he met a girl and then he got married, and then and then through the whole experience, I think he like sort of become like a changed man, and he sort of like gone back to his fundamental, which is like value investor, like focus on the value of a company, focus on the free cash flow generation. And I mean, his fund has done tremendously, man. I think his fund last year was up, I think like 70% or like 80%, I don't know. And then the year before that, before the pandemic, his fund was also up a lot. I think it was 60% or like 50%. And then, of course, last year he also made a hedge, I think from like a 20-something million become like $2.6 billion, 100x return in like a few months. So I think he have gone back to his roots of really like buying like quality companies, understanding the valuation, understanding the business. And I like that. Yeah. But of course, it's not like a position in a portfolio where it's my highest conviction for sure. So I think SPAC is ultimately, there's some speculative aspect to it, in the sense of we don't know which company they're going to merge with and at what price. So I think we have to accept that, and we have to understand that.
So just curious, right? You've talked about all the positive stuff about Pershing Square, like, and you entered a position to that. But when's the time when you will actually call it quits? Like, okay, next quarter they don't merge with anything already. That's it. I'm going to exit all my holdings. Do you have something like
Huh.
that in mind?
No, in fact, when I invest in any company, right? Okay, of course, some like business, I have a certain time horizon. So, for example, if the investment is special situations, if it's a turnaround play or if it's a rebound play, then I have like that kind of like time horizon. But
GameStop,
if
GameStop, GameStop.
but if it's a spec, right? If it's a spec, and I think I've determined that okay, my percentage of the portfolio is not too big, it's a size that I'm comfortable with, then really I don't really care like so much. I'll just like, because they have about 2 years, right? So let's see what happens. And like sort of like the floor is that your like drawdown is likely just if you invest at a 25% premium, then your drawdown is probably about that 0.25 out of 1.25. Yeah.
Fair points. Okay, cool. By the way, anyone, if you have more questions, thanks for all the questions. Please keep them coming. Okay, don't be too cordial, right? We clearly we want to get the best and all the juices out for you. Okay, so we've talked about Pershing, and we talk about SPAC in general. Okay, so understanding that a SPAC, before it goes for a merger, before there are big news, there may be a premium, and you got to decide whether is this premium worth it for you. And you got to look at the manager, you got to look at the investment theses. Essentially, a SPAC is quite a private way of investing. It's very common in the private space with VCs and PE funds. That's kind of how they do it. The fund manager will have this like big idea that okay, we're gonna do this, and we're gonna raise money, and then you put money with them, and then they will do all the execution. They will send you periodic reports. So SPAC is quite a listed vehicle that is very similar to how private people invest their money. So it may not be very, very comfortable for a lot of young new investors, but you can learn about it and see how that brings us. Okay, so then we got to move to the next company, which is what you call a reopening play, right? There's a term for that these days, right? So why Carnival Cruise, and why cruise? I mean, there's so many things that you can buy for reopening, right? Like Marriott, who's that? Who's the other one? Hilton. I mean, all the asset light hotel brands, but you want to talk about cruise.
I mean, it's quite interesting. I think back in like March 2020, I'm already more or less, if I'm not wrong, vested in Carnival Cruise. So it's actually a play that I like sort of like went in at the height of the pandemic. I started like going in like maybe like 8, 9, 9, 10, 11, $12 ish, and now it's about like $28. And the reason for that is that basically there's quite a couple of reasons. The first being the fact that I think the vaccines are going to work at that point in time, because at like March, May, June last year, we don't know if the vaccine is going to work, etc. So I also like had a position in Pfizer call options, like also around that time, June 2020. I just sold it off at about like 90% gain quite recently. So the reason for cruise is because of like the fact that there's like pent-up demand. And at that point in time, I like sort of chanced upon like Carnival Cruise, and then I did like your standard like DCF evaluation, and of course at that point in time, zero like revenue, right? So I had to like forecast and make certain assumptions. Okay, even if they have zero revenue for this year, and let's say next year is just this amount, then next year is this amount, blah blah blah. And then I think there was some good like potential upside for Carnival back then. Then of course I have some stocks, and then as time goes by, I like sort of like converted the stocks, and then now it's like mostly in call options. And really the reason for why cruise is because I mean I went on cruise to nowhere in Singapore, and I loved it.
Okay.
And I think business travel, right, might resume slower, because now if you can Zoom, you don't really need to fly on an airplane just for business, right? Unless it's like very, very, very important meeting. But if leisure for like having fun and like really just going out, and after this like one whole year of lockdown, you just want to travel, even cruise to nowhere, the demand was really good, right? For like Royal Caribbean. So you see like I think like logically speaking, there will be good demand for like leisure, and there will be good demand for like reopening, especially once more people are vaccinated. The risk will be lower, and that's what you're seeing in the US, because in the US the CDC have started to say that okay, cruise lines can finally start cruising again in July and August. That's why you see all the three big cruises, Royal Caribbean, Norwegian, and the world's largest Carnival cruise. They actually like went up a little bit. And also, I mean, one of the reason is also, of course, very important reason, because when we invest, right, we need to have certainty. I need to make sure that this company won't go bankrupt, because if this company go bankrupt, then there's no point, right? It's game over. So like back then, their liquidity, they managed to have enough cash to last. I think now they have enough cash to last until 2022. So the chance of them like going like bankrupt is low. And of course, it's a bet on when they're going to reopen, and it's a bet on pent-up demand. There's no point to reopen if nobody wants to go on cruise. But you notice that despite COVID, people still want to go on cruise. And I think there's opportunity for that. And like Carnival has quite strong like backers also. Back in the depth of the March crisis or March 2020, I think, if I'm not wrong, the Saudi Arabia fund invested like close to 10% in Carnival Cruise as well.
Nice. Do you want to help us elaborate a little bit on the business model of Carnival Cruise? Okay, so why am I asking? Because a lot of people, when they think about cruise lines, right, they think about like, oh, just going for holiday, one place to another, 10 days or like 8 days cruise or whatnot. Actually, there's a very big bunch of people that are essentially retiring on cruise lines. Right. Right. There's a very big bunch of people, it's a very sizable business, that they literally just retire on cruise lines and they just keep going around together with the cruise. Do you want to help us elaborate on this business model that, it's not really talked about?
I mean, like, I think before the pandemic, Carnival's brands, right, attract about 13 million guests annually. So about 13 million people actually went on cruise with like Carnival brands pre-pandemic, and it's the world's largest like global cruise like company. I think last time they have about 100 cruises. Then after selling some of the like leaner ships, they have about like 88 or something like that. So they have brands like Holland America, Princess Cruises, Seabourn, P&O, Cunard Lines, Costa Cruise, and they target different markets. So in the United Kingdom, they have P&O Cruise and the Cunard Line. Southern Europe, they have Costa Cruise. And North America, they have Carnival Cruise, Holland America, Princess Cruise, and Seabourn. So each of these brands not only like target different market, but also target different, not only target different country, but they also target different market segment. So they are the more premium cruise, where those who can like fork out more. Then the food also nicer, the space also bigger, right? Then like the age are usually older, so. Then they are like the brand where it's more for mass market. Then maybe you see more of the younger people. Then of course, like just now, like you mentioned, like people like retire on like cruise. Yeah, so I mean, like if you think about it, cruise are actually quite value of money, because you get to sleep there, you get food, free flow food, and you get to watch the sea. And I think like generally there's a sense of like calming about watching the sea, especially after a year of pandemic. So they basically like target lots of like different like market segment. And like recently in the Royal Cruise, they were like traveling in the cruise to nowhere in Singapore. If I'm not wrong, I read like there are more like younger people actually going on cruise, and there are more first time cruise. There are more first timers going on cruise as well. So I think there's a huge market to be tapped.
So what's the holding period for you like that? So Carnival is currently we have these different segments, different kind of cruise ships for different geographies and different target markets, right? But what else is there in Carnival which like makes you want to hold longer?
Well, I think for those who are listening, I think it's a good idea to determine if the company that you are invested in or want to invest in, is this like a great long-term compounder, or is it just a so-so or good business? So just like Reggie was saying, why don't you get those like asset light and those like asset light business? Why do you need to get like cruise which are like high in capex? So
Super high in capex. It's
yeah,
like
I mean,
airlines is here, cruise is next. You know, of all
yeah.
the reopening play, you had to choose cruise. But anyway, yes, continue.
So I think each business, the key is that you have to understand what is your price valuation of it and what's the current price. And like sometimes if you look at those like great companies, the sad thing about them is that they are usually not trading at such a great price. And sometimes the value to price gap might not be as big as another play, for example, cruise lines, right? I mean, like cruise line, people hate it, at like COVID times, like cruise are the worst, so people hate it so much. And in my portfolio, there's always a place for great long-term compounder, and there's always a place for turnaround. And based on my history, my turnaround play has been doing very, very, very well. And like of course the like long-term compounder has done like quite well too. But for cruise lines in particular, I have a time horizon of just this year, because I have a rough like target price for Carnival Cruise based on my few like assumptions. So, and furthermore, I went in via call options, and my call options will expire, I think, January 2022. And the nearer to expiry, the bigger the time decay, especially if it's out of the money. But if it's in the money, then there's like a little bit safer. But the idea is that when you invest in the call options, there's like a time horizon to it. So for Carnival Cruise, if it's like sort of like reach my valuation target, then I will start to slowly like unwound it. Yeah.
Nice. Okay, so like you said, right, in this cruise space, it's not just Carnival alone. There are other players. So there are three other players, right? There are two other players, major players. So why Carnival compared to the other two of them?
Yeah. So Carnival is in a like what you call like oligopoly, with like Royal Caribbean and Norwegian. And why Carnival? So back then, why I decided on Carnival, because the other two have gone up like quite a bit, and like the valuation price to value gap for Carnival seems to be the widest back then. And also before the pandemic, their leverage is the lowest among the three companies, and also like Carnival's like multiple brands seems to target more of the mass market, so that I think that when the reopening comes, they can sell their tickets easier because it's more mass market as compared to Royal Caribbean that is more like slightly, like middle premium market. Yeah, I mean, like those are the few reasons. But like if you look at the three companies, like more or less they move the same way.
Yeah, they move parallel. But yes, I get the whole like premium valuation kind of thing. Okay, so that's pretty cool. I think you share a lot of good stuff. Just want to give a last shout out. If you guys have any question, faster put it in the comments, before we end today. And yeah, we got questions. Okay, we got question. So is it normal for share price to drop after a SPAC merger? Yes, I think we got a lot of SPAC interest. By the way, just want to shout out, right? Pershing Square is doing an investor relation call later tonight. Right.
Wow.
So, yeah, later tonight. So if you want to check them out, you should listen to the investor relation call. Anyway, yes, someone asked, is it normal for share price to drop after a SPAC merger?
Okay. Okay, so this question is there should be something before that question, which is like if let's say the expectation doesn't meet the reality, then the share price will drop. If if the reality is better than the expectation, then the share price will rise. It's as simple as that. So I don't think there's like normal or not normal. Really depends on the kind of like premium that you're talking about. So for example, like AGC SPAC, I think it went up after the Grab merger, right? Then it went down. Why? But you wouldn't call it normal or not normal, because it went down because the whole environment has like changed a little bit with some questions on like whether like people are paying too much premium for these like growth companies, and like Grab is also a growth companies, and like inflation, blah blah blah. So always invest with a margin of safety. I think that's a good philosophy to live by, because you don't know what will happen. So you don't want to overpay too much. Even though sometimes for great businesses who really execute very well, then but you also don't want to overpay too much.
Be a cheapo. Yes.
Yeah, I think this one is
okay.
to do with more of the valuation side of things also. Normal or not normal really depends on the deal itself. So for a SPAC, if let's say they overpaid for the merger, right, then that's not going to be very good on the share price, perhaps, right? But you got to do a valuation on both sides, the SPAC as well as the target.
Yeah, because I remember as an investor, right, there's only a few things that we can control. The first is that what you invest in, and the second is the price you pay. So be very careful about the price you pay, because sometimes if you look in deals, acquisitions, M&A, private equity, sometimes I think the biggest key determinant of your return is the price you pay. As simple as that.
Okay, we have another question. Siki asks, why use LEAP, LEAP, instead of commons?
Leap options.
Yeah, I mean, there's when we invest, we try to understand the business, and we try to understand the value and the current price and what's the gap, right? And then what I try to do is that I try to think, if I invest the stock, what's my potential upside? Then if I invest in the LEAP, what's my potential upside? Because investment is all about opportunity costs, not only within the stocks that you have in your portfolio, but within the strategy that you use to invest. So LEAPs are very dangerous, especially for people who don't understand it, because it's easier to lose all of your money through LEAPs than it is through stocks. But I would say, why use LEAP instead of commons? There are some situations where it's more attractive to use LEAPs than common stock.
Thank you. Okay, we got one more question. Since you talk about margin of safety, right? So what is a good margin of safety advice? Okay, I mean, this is what the person said. And I mean, the market is still reacting to the pandemic.
Yeah, sure. Okay, so I cannot give like financial advice, but like, but I can give like philosophical advice. Okay, I would say that look at the business. The riskier the business, the higher the margin of safety that you should give. So if let's say the business is very risky, right? If let's say the business is on the verge of bankruptcy, then maybe you want to give 90% margin of safety, right? Just to like ensure that, just in case. But if let's say the business is very solid, right? Let's say already like a mature company, let's say like, I don't know, Amazon or Facebook. If let's say it's of a big company, then maybe you want to give like lesser margin of safety. But I cannot say for a specific stock, because it really depends on your assumptions of the company and your assumptions of the risk of the company. So the riskier it is, the higher margin of safety. The less risk, maybe like lower, like 10, 15, 20%. Yeah.
Cool. Okay, I think that's all the questions that we have. If you guys have any questions, like last 5 seconds. But yeah, I think we're gonna wrap up. So thanks for coming on together with us. I think you share a lot of good stuff with us. And if you guys want to check Chris out, definitely head over to rethinkwealth.com, rethinkwealth.com. Okay, I think everything is in the description detail. Chris, do you have any last words for our community, of our listeners? Anything else you want to share with us?
I think when we invest, we need to ensure that we understand what we are investing in, and not be too sucked into the emotions or the hype of like stocks or like companies or cryptos or whatever, because we must ensure that we are investing in something that is sustainable. That is ultimately what will be the determinant of our long-term returns, not the current hype. Even if the current hype, you must make sure that it's something that is real solid, fundamentally sound, and something sustainable, something that you can see will be worth more in 3 years, 5 years. And yeah, always ensure that when you invest, you think of the downside risk first before you think of the upside risk. Think of what could go wrong before you think of what could go right.
Nice. Okay, so thank you for spending time with us. Stay tuned tomorrow for more good content. I know it's VSUC Day. Happy holidays. And if you want to hang out with us, join our Telegram group. Also be a member to receive early release, premium investment content, all those kind of stuff. So just go to thefinancialcoconut.com for more details. And once again, thank you for spending time together. We'll see you next week for stock specific stuff, and then just kind of keep coming on, for all the other stuff that we have for you. So thanks, Chris. Thanks, Thomas.
All right,
And thank you all of
thanks.
you. Take care, guys. Bye.
Bye.